Everybody, this is Victor Medina with Palante Wealth Advisors, and I've got a new question of the week for you, which is, should you be worried about investing in China? China's been getting a lot of attention. The world's most populous country has made headlines, including the China question and the new China, opportunity or threat, and China-US face off over reforms. Now, surely these articles have come out recently in response to the latest groundbreaking events coming out of China, right? Well, think again. In fact, all of the headlines that I just quoted were actually made in 2005. Media coverage around China is not a 2021 phenomenon, and although China has been making headlines for decades now, you're actually not wrong to have noticed that it's been a more popular topic as of late. There's a U.S. executive order regarding Communist China military companies, there are sustainability and social issues there's the introduction of a nationwide property tax, and of course we had the financial troubles of China Evergrande. And for all of that, this particular country has been a popular subject across newspapers, television, social media. You go looking for it, you can definitely find it. Now, while these headlines may be alarming, they actually tell us something interesting from an investing standpoint. They tell us that the news is being widely publicized across investors around the world, and fresh information about China is being shared quickly with millions of people who are in the market, who react to this information by adjusting the expectations around risks and returns. Point is that market prices instantly reflect this information, including political and country-specific risk. And on top of that, China's relative size in the world stock market actually may be smaller than you think. At the end of 2020, China's equity market only represented about $3.5 trillion, while the U.S. has a stock market size of $41.9 trillion. It's almost 13 times the size of that. And it is true that China's economy has grown over recent years, but even now it only makes up about 5% of the global stock market. So a particular equity security in China is going to be a fraction of 5% of the global stock market. Population size, GDP, export rates don't necessarily imply the amount of exposure that your portfolio should have to a country. So all the news about how much trading is going on there is not necessarily reflective of what you should be doing with your investing. Remember, the economy is not the stock market. The stock market is not the economy. As we always say and preach, you should control what you can control. And diversification is one of the most effective ways to reduce country and company-specific risk within your portfolio. Broad diversification can actually help ensure that your investment outcomes are not driven by a single company or even a single country. Now, if you have a daily portfolio management approach that has flexibility built into its process, that's going to be key. For Dimensional, which makes up the biggest percentage of the holdings that our clients have in their stock portfolios, the benefits of this approach are actually highlighted in how they handled China Evergrande. When its price rose sharply, that indicated a decrease in its expected return. Remember, companies with high relative prices tend to have lower expected returns. And then they trimmed the position in the portfolios. So Dimensional has a systematic monitoring process. And so when a company encountered financial distress, they were able to divest their holdings. And as of September 28th, 2021, there are actually no Dimensional funds, trusts, or ETFs that had any direct exposure to China Evergrande Group. This response is not unique to this particular company. Dimensional's flexible approach has allowed them to monitor expectations around risk and returns every day. And when determining which countries to invest in, they take into account any new restrictions, taxes, impediments to accessing the market. For example, Dimensional's investment committee made Argentina ineligible for strategies in 2001. It wasn't until 8 years later, 2009, that the Morgan Stanley Consumer Index removed Argentina from its emerging markets index. So again, Dimensional ahead of the curve when learning about this and flexible in its approach. Now, for their own unique reasons, there may be some investors that are hesitant to invest in China. And for that, Dimensional is going to be launching a new emerging markets ex-China, meaning there's no China in there, core equity portfolio around mid-November. This portfolio might be appropriate for those investors who want to maintain a broad diversification while tilting towards area of the market with higher expected returns, again, small value and profitability. Now, no one can say with certainty what the future holds for China, or any country for that matter. The important thing to remember is that when you see a headline, likely investors around the world are also looking at that news. Any information around risk and return then can be quickly incorporated into the market, and diversification provides more flexibility in implementation and helps increase the reliability of expected outperformance. The key takeaway from this is to recognize that as you see more news, being shared out in the world, it's already incorporated into the market price. And because we've got our high concentration in dimensional funds, we've got flexibility about getting in and out and reacting to that information in a way that helps maintain the diverse portfolio. No matter what you hear about China or anywhere else, recognize that it's a small fraction of the overall market, and for that reason, any movement in there is unlikely to have a major effect on your overall portfolio. So hopefully this helped answer the question, should you be worried about investing in China? The short answer is no. You shouldn't be worried, especially with us at the helm. Now, if you're watching this and we are not your investment advisor or retirement planner, we invite you to start a conversation. You can reach out to us at 609-818-0068 or by email, and just let us know that you're interested in meeting with us, and we'll see if there might be a good fit between us and you, your goals, and what we can provide. We'd love the opportunity to meet with you a little bit more. And if you are a client, you know you should be resting easy at night anyway, which is just a good video to let you know that in fact we are monitoring what's going on. No one's asleep at the wheel for you. This has been Victor Medina with Palante Wealth Advisors and Medina Law Group with the question of the week. Hope it's been educational for you. We'll catch you soon. Bye-bye. Hey, it's Victor. If you liked that video, don't forget to hit the subscribe button as well as the notification bell so you can get alerted anytime we post new content. In addition, we've got some other great videos for you to check out as you go on your retirement planning journey.